Welcome to Chapter 2, Financial Statement Analysis. In this chapter, we're going to talk about financial reporting and analysis. Financial reporting and analysis is really a function of what accountants do. And we really want to talk specifically about rules that accountants are required to follow and how those rules are established as a foundation for financial statement analysis. Because the rules that those accountants follow help to determine the numbers that are the output out of in financial statements. The rules that accountants follow are called generally accepted accounting principles in the United States, typically referred to as GAAP. They provide the foundation or the principles that accountants need to follow when they establish financial statements. Who provides these rules and who governs the rules? Well, there's several different groups. There's environmental factors that drive those rules. And if you kind of look at this particular slide, you look all the way at the bottom, the generally accepted accounting principles, even though the arrows point down, what it's really saying is those principles are established based off of input from the Securities and Exchange Commission, unions, investors, AICP is all this up in that box in the top. They give guidance to the Financial Accounting Standards Boards who help set the rules that are governing accountants when they do financial statements in a business. The financial environmental factors, the Securities and Exchange Commission is an independent body of a government agency that administers the Securities and Exchange rules and regulations and disclosures. And they can modify and accept GAAP as necessary, but rarely do they do that. Do they really challenge the FASB? They're a major player in global accounting. That's the Securities and Exchange Commission. What are the various reports that a public company must file with the Securities and Exchange Commission, the SEC? You have a 10K, which is commonly referred to as the annual report, the 10Q, which is a quarterly, the 20F, which is a registration statement or their annual report for a foreign company, the 8K, which is a current report, and any proxy statements, and any other stuff. Now, all of these things are going to be important to you when you do your financial statement analysis because they go into deeper analysis on certain accounts that you're going to need to do for your financial analysis of your company. What are the environmental factors that affect the reporting of various financial statements? Well, there's several. One is the International Financial Reporting Standards, IFRS as it's commonly referred to, and they're set by a board in Europe, and they're not accepted in the US as of yet. And they're trying to harmonize those, but they have not been done yet. But they impact the financial statements, particularly for companies that have international operations, where they have consolidation of international operations into the U.S. company. And the other environmental factors, managers of companies have an impact on the financial statements of a business. Their responsibility is to make certain that everything is reported fair and accurate. Remember, they're doing stuff at the detail level, and it rolls up into the summary level in the financial statements. They apply the accounting to reflect the business activities. And each business might be a little bit different, but they definitely have an impact on how to apply generally accepted accounting principles within their business. And they have management discretion or managerial discretion about how they apply those particular principles within their business. Auditing. The SEC requires an audit report. Many of you probably work for companies that are audited or organizations that are audited. Well, for the SEC requires an audit report, and what they're trying to do is make certain that the financial statements fairly represent, in this top opinion, fairly represent that there is that the financials represent the financial condition of the business. Qualified means that they have some concern with the financial report. Let's say they say, we have a qualified opinion, but we could not attest to all of the inventory balances because certain facilities were unavailable. That would be a qualified opinion. Sometimes a company might have a qualified opinion. Let's say you were in New Orleans during the hurricanes like Hurricane Katrina. The audit company might present an audit report that says that they have a qualified opinion because they couldn't attest to all your inventories. And this last one is this check auditor quality and independence. You want to have independent auditors for your business. You have internal auditors. Some of you may work for companies that have internal auditors, and your responsibility is to really look at the processes within the business and make them better. Their responsibility is not to attest to the financial statements of a business, because obviously that has the potential to be a conflict of interest with employees attesting to the financial condition of the business. So that's auditor independence. So you have these for irregularities and errors. For conformity, there's different qualifications. The except for qualification, which we just saw. The adverse opinion says something like it's a real negative. There's something wrong with their financial statements, and a disclaimer of their opinion. Each one of these are qualified opinions on financial statements, and if you have a business that has one of these, it's not a good thing at all. Environmental factors, you have corporate governance. You have a board of directors that watches over what happens. The board of directors typically is not involved in the day-to-day operations of the business. They also have a separate arm that's called the audit committee of the board of directors, and typically that audit committee only reports directly to the chief executive officer or the chairman of the board. They are very independent of the organization, typically, if they're set up, and they oversee the accounting process to make certain it's right through typically an external auditor, like from one of the big four, and they oversee both internal and external audit. And you have internal auditors, but really they're not going to be attesting to the sufficiency of the financial statements. Internal auditors are really going to make certain that the organization is running appropriately. We touched on this a little bit in the last chapter. You have internal and external users that have environmental factors and imply or have implications for the financial statements. And I'm not going to read all these. You can read who you have, but each one of these influences their financial statements. But remember, the ones on the right, these external users, all they're really going to see in the financial statements is kind of the 40,000 foot view, whereas the internal users are going to look at detail by different areas of the business, because they're using financial statements and detailed financial statements to help manage the business and drive profitability. What are some various alternative sources of information that is available that is not provided to management of the company? What I'm really talking about here is different places where you can find information. Why is this important? Well, it's very important when you start doing your analysis of your business, because not only are you going to look at the business itself, you also want to look at your competition and things that are going on. And so you might have an idea. For example, let's say you're doing Sears right now, or JCPenney's. If you did Sears or JCPenney's, Sears, I think most of us probably know, is starting to fail as a company because it's really Sears Kmart. And JCPenney has started to introduce appliances. Well, that's kind of an interesting thing to look at. You'd say, well, why is JCPenney introducing appliances in their stores? Well, part of that is because they want to try and take advantage of what's happening in Sears. So you can look at what's happening in the business. You can look at general economic conditions. Let's say you're doing an oil and gas company. Well, there's going to be general economic conditions and also government things that might impact oil and gas, like the pipeline that's trying to go through in North Dakota. Those are the kind of things that you want to take a look at that might impact. You know, obviously, like I talked about earlier, company news and what's happening with companies. The companies also have to do voluntary disclosures. Sometimes you can see that on their website. Sometimes you can see that in their financial statements. But there's a lot of things that they have to disclose in their financial statements that you can read and understand what's going on. The financial statements are interesting, and what you're going to see in the 10Q and the 10K is really interesting, but the notes to the financial statements are going to give you a lot more insight into what's going on in the business, including the management discussion and analysis and the chairman's letter and all those kind of things. Finally, if you see on the bottom here, you have information intermediaries, and there's a couple of different places you can look at for this. One is just trade groups. You might have an association of bicycle manufacturers, an association of poultry processors, association of metal of steel workers or steel companies. All those kind of things have an idea of what's going on within the business, and they can provide you some insight into the key drivers of the business. And there might be also trade magazines. They might not have numbers, but they're going to give you insights into really what's happening in the industry overall. You know, our sales up, are they down? Our placements, are the supply up, or is it down? What are the key drivers in the business? If you read some of those trade magazines, that'll give you an idea of what's really happening in your industry. What are the key desirable attributes that an analyst wants to see in a financial statement being reviewed? Several. One is relevance, the capacity of the information to affect a decision. Is the financial statement relevant to the holder of the financial statements? Reliability. Is the financial statement reliable? Does it present numbers that are true and accurate and they're neutral, they're unbiased, they are truthful? And can you verify them? And is it faithful? Does it faithfully represent the condition of the business? They want the numbers to be reliable. And along with that, even though it's not here as consistent, a lot of the financials that you look at a business, if they are on a specific trend and you see something that becomes an anomaly, that's really a problem, because that calls into question the reliability of the financial statements. So every quarter for the last 4 years, the business has made a certain amount of money, and it's kind of continued to go up. And then you get to a quarter where all of a sudden they lose money. The reliability comes into question from a consistency perspective. Now, there might be some reasons for that, and that's the things that we want to see when we do financial statement analysis a little bit. What are the key limitations related to financial statements? Well, for one thing, timeliness. Some of you work in companies, and the companies close their books. You might close your books in 5 days, but you may not be required to report on a quarterly basis for 30 to 45 days or even longer after that to your board and to the industry. And you may not have, some of you have conference calls. Well, by the time that information is reported, it's already pretty stale. I mean, if it's 45 days old, that'd be pretty moldy if it was bred. So timeliness is really important. It's not on a real-time basis. Now, the flip side of that is if those financial statements were on a real-time basis, it would be a serious problem, because there's always things that happen through the month and through a quarter that go one way and then they go another way. They go back and forth and back and forth and back and forth. So you'd spend so much time analyzing that you'd never be able to run your business, because people would be basically micromanaging your business. And you notice here it talks about the frequency, quarterly and annually. Internal to the business, you look at stuff, sometimes you look at it daily, weekly, monthly, but for certain you look at it monthly, because you close your books and you evaluate what your financial position is for a month. And it gives you a perspective on where the business is. But remember, financial statements are historical documents. They're not forward-looking, this last point. They're looking backwards on what's happening in the business, not what's going forward. And so we could add to what's happening in the financial statements, but you know what? It becomes difficult. There's this adage when you see some of the news, it says past performance. Some of the investor stuff says past performance is not an indicator of future activity. So financial statements are very consistent with that. They are not forward-looking. They're historical documents, and that's a limitation. What are some of the key concepts related to financial statements? Well, historical cost is one. That's governed by GAAP, and you're responsible to put stuff on the financial statements at historical cost, not at fair cost. And that's one of the differences between GAAP and the General Accepted Accounting Principles of IFRS, or the International Financial Recording Transactions. Accrual accounting. Accrual means that expenses and revenues are put on your financial statements when they were earned. So a real simple example of accrual accounting, and let's try and talk through this really quickly, is when you sell something and you sell it on account, well, you debit accounts receivable and you credit sales. That's accrual basis, because cash has not come in yet. Maybe cash won't come in for 30 days, but you recognize that revenue because you delivered product and you're waiting for it to be paid. That's accrual accounting. Cash accounting would say that you would only recognize that revenue when the check for the stuff that you provided comes in. GAAP requires accrual-based accounting. Materiality. Each business has a different materiality threshold. It's the size of the financial statements. I worked at Pilgrim's Pride. Our materiality threshold was $1 million. If we had an issue in our financial statements and it was less than $1 million, from an audit perspective, we wouldn't go for it. Conservatism. You can read what it says here: reporting or disclosing the least optimistic information about uncertain events and transactions. A better way to say this is anticipate no gains and recognize all losses. Let me say that again. Anticipate no gains and realize all losses. That way you have a fairly presented, you put a negative spin on your financials, which is a better way to look at it. Are all financial statements recorded using historical cost method? If they're not, is there any other method recording various accounting transactions? There's something called fair value accounting, where you typically put stuff on your book at market prices, and it's measured at the time of the financial statements. So it could be all over the board. So let's take a look at this example. Let's look first at this condominium in the assets. The historical cost is $100,000. After the first year, it went down to, at closing, it went down to $99,500, and in the next year, it went down to $99,000. But on a fair value, it went from 100 to 125 to 110. So there's fluctuation in the fair value of the condominium. The same thing if you look at the debt, it moves all over the board based off of what happened. And the same thing for rental income on the bottom. So you have all these different things that are really driving, and you notice how the financial statements look in year one. You have rental income of $12,000 in both years, and then you look, you have depreciation in year one for the condominium, but you have no depreciation for year one for the on the fair value basis. You have interest expense for both, and you have an unrealized gain on the condo, and you have an unrealized gain on the debt. So fair value wise, you would have made $36,000, whereas on the historical basis, which is really how GAAP is, and if you were to look at this, the fair value is pretty much how GAAP operates. I mean, like the historical cost is pretty much how GAAP operates, and the fair value is pretty much how IFRS or the international standards are established. What are the key concepts to reporting income? There's really a couple of them. Of course, we touched on the accrual accounting, and the main purpose is the income measurement, but also we want to look at two processes: revenue recognition and expense matching. Revenue recognition, revenue is reported when incurred. Matching says that we want to match expenses with revenues. So I don't want to have a revenue, but I don't have the expenses associated with it. If you can remember all the way back to probably chapter 3 of your Principles 1 class, you did adjusting entries. Those adjusting entries, such as depreciation, for example, were meant to match revenues and expenses so that you had the appropriate amount of expenses reported on your balance sheet relative to the revenues. Same thing with prepaid insurance, for example. That's another one where you're trying to match the insurance expense to the revenue that was generated relative to that insurance expense, so you do an adjusting entry. Accruals is the cornerstone. You have net income is equal operating cash flows plus accruals. So that's really how you look at the financial statements of a business. The foundations of accrual accounting, we already touched on this. Revenue recognition, earned when it's realized or realizable, an expense. We want to match with the product cost with the revenues and the period cost with the revenues. Product cost is really going to fall into cost of goods sold, and period cost, if you're doing a business that has sales and general administrative expenses, which all you will for your financial analysis, period's going to cost are typically going to be called selling and general administrative expenses are going to be period cost. They're going to be the same no matter what. Now, if you're doing a retailer, say Nordstrom, those period costs might be store operating cost. Here's several myths. The first, since company value depends on future cash flows, only current cash flows are relevant for valuation. All cash flows are value relevant. All accrual accounting adjustments are value irrelevant. Cash flows cannot be manipulated. All income is manipulated. It is possible to consistently manage income upward in the long run. All these are myths. Let's take a look. Truth. Accrual income is more relevant than cash flow. Cash flows are more reliable than accruals, which is true because cash is king. Accrual accounting numbers are subject to accounting distortions. Yes, they are, because all accounting distortions, all accruals are based off of estimates. And if you can support it with your auditor, they're going to let you do it. And the sad thing is some of the auditors are new and they don't understand your particular business, or they audit multiple different types of businesses and they don't have a handle on how each business works. And the company can be developed, and company value can be determined by using accrual accounting numbers. Those are the truths. What are the key reasons to perform accounting analyst? I think it's analysis. Demand for accounting analysis. Adjust for accounting distortion so financial reports better reflect economic reality. Adjusting general purpose financial statements to meet the needs of the analysis of a particular user. So one thing you'll have to be careful of is when you are comparing your company to a comparison company. Let's say you have Starbucks and you're comparing it to Dunkin' Donuts. You want to look at their financial statements and make certain they're following the same philosophies as far as some of their accounting practices and major accounting practices, so you know exactly how it's reported, because you might need to make adjustments to some of the financial statements for one or the other. Sources of distortion. Accounting standards, because they're attributed to the political process of standard processing, standard setting, accounting principles and assumptions, and conservatism. Some companies are much more aggressive. For example, they may decide to expense computers in one business, whereas another business might decide to capitalize them. So what's the impact? Maybe a company that has a computer, maybe a company that capitalizes or puts them on there as an asset, they might expense them over 3 years, whereas a company that puts them on and expenses them, they're going to expense it all at once. So let's say a business buys $30 million worth of computers. I know that's a big number, but it's a good illustration. If they expense it all in 1 year, they take a $30 million expense hit in 1 year. In years 2 and 3, they don't have that, but they have $30 million hit every 3 years, presumably because they're going to replace $30 million worth of computers. Or the flip side is, if a business says, no, we're going to depreciate it $10 million once every year. So you have 10 million in year 1, 10 million in year 2, and 10 million in year 3. Well, now what happens is there's not comparability between those two. So they have different philosophies depending upon what a business wants to do. Estimation errors. They determine how they're going to estimate stuff. And it's really, it's all human and what they can determine. And reliability versus relevance. If you make stuff too reliable, it may not be relevant. And finally, earnings management. We'll talk a little bit more about earnings management here in a minute. But essentially, businesses sometimes they may try to manage their financials really for the benefit of the managers or for the organization. Because the managers may have an incentive to have a certain amount of income for the business so that they can hit their bonus targets, for example. So here's some of the stuff that they do. Earnings management strategies, increasing income. They adjust accruals to increase reported income. So they might say that they want to have more credits on their balance sheet, or vice versa. They want to have less credits on their balance sheet. So some places you might look at that as allowance for doubtful accounts might be a prime example where they might estimate some of those accruals. And how are you going to find this? You have to look in the notes of the financial statements. A big bath. Big Bath says that what it says here is it says they have huge write-offs in one period, and then they can use those write-offs over time, so long as they can justify those write-offs. They can use those write-offs over a period of time afterwards. They might say, okay, let's say we're going to lose $50 million this year. We've decided, well, since we're going to lose 50, what's the difference between 50 and 100? They're both really bad, but it's all order of magnitude. So what they may do is say, well, let's take a big bath and show that we're losing $100 million. And then over the next 4 years, we can bring back approximately $10 million each year, so long as we can justify it with our auditors. That's something that they'll do as well. And then this last one is income smoothing. And what they try and do is make certain that their financials are okay and smooth. And they may do that by pushing sales out or keeping them close, but they want to make certain consistency of earnings, so they play with their numbers so the numbers are smooth. So how do they do that? And this is more of it, more motivations. Contract incentives and stock prices go hand in hand. One has to do with bonuses more than anything else. That's what they're really trying to say here. Stock prices, companies are measured, and they think stock prices are indicative of what happens, but also companies have stock options, or employees have stock options, particularly senior managers have stock options. So they might want the stock price to be a certain level because they're anticipating retirement, for example. So they can play with the numbers. And one of the things they might elect to do as well, if you're a CEO of a company and you think you're going to retire in the next couple of years and you want to make a lot of money, what you might do is cut off all maintenance spending. Or let's say you're a drug company guy and you say, well, we're going to slash research and development spending by 40%. And in the short run, it's not going to hurt the business at all because that whatever they're selling currently is making money for them. That slashing of the research and development money may not hurt them for 5 or 10 years down the road. So this person is trying to line their pockets by making decisions that will impact the business's profitability, but maybe will go unseen. In that R&D case of a drug company, it would be pretty noticeable. In the outside analysts that follow that company would know that there's something amiss and that it's going to hurt the business long term. And then sometimes they want to do this because they have labor demands. Maybe there's a contract that's coming up. They have management changes. Sometimes when you have a new manager comes in, he might not do it. He might do a quasi big bath where he wants to show that the other guy was really terrible and he's fixing everything that he did wrong, his predecessor. And then in the long run, this guy makes a change to the numbers. And then what society expects a business to make. If it's let's say your business is typically philanthropic and they give away a lot of money and society expects you not to make a bunch of money, you might manipulate the numbers to make society think that's good, because if you make too much money, if you're kind of a tree hugging type of a business, then society may not be willing to buy your product. Income shifting, that means putting revenues before or after. They might try and accelerate sales to have a better quarter or a better year, or they might try and decelerate it so it goes into the next year. And you can do the same thing with expenses. Why would that matter? It matters in a lot of different ways, because a business might want to fill up the warehouses, so they can do something called channel stuffing, where what they'll do is they'll shift everything, they'll sell as much as they can, and they'll do incentives to get stuff out of their inventory at year end, and they know they're making money on it. But then over the long haul, in the next quarter or the next month, they're really light on sales. They say, well, I'll take a good year this year and deal with a bad year next year. And then you have management of classificatory earnings management, selectively classifying revenues and earnings and expenses in certain parts. Management and the income statement to affect analysis inferences, recurring nature of these items. So they're just trying to play again with the revenues and expenses to impact earnings, is really what that's saying. What's the process of accounting analysis? It involves looking at interrelated processes and trying to understand what's going on. Evaluating the earnings quality steps. Identifying and assess the key accounting policies. That's what you're doing when you read the notes of the financial statements. Evaluate the extent of accounting flexibility. Based off of what is written in those notes, does the business have a lot of changes, or have the ability to make changes? What's the reporting strategy? What are they trying to do? What's their goal? Are they, some businesses will say our goal is to have increased profits every quarter. Well, eventually that could come back to bite you. So you have to read a little bit between the tea leaves on what's going on with the financials. Look at red flags. Typically the red flags are going to be things that you see from a trending perspective. And then if you see trends and something happens, there's going to be a red flag. You can see that if something is very consistent always and then there's a change, that's a red flag that something has happened different in the business. You want to understand why that happened. And finally, adjusting financial statements. You want to make the necessary changes to your financial statements and also the competitors that you're going to use for your analysis, so that you are comparing an apple to an apple. Because if you don't make those adjustments, you're comparing an apple to an orange, and it doesn't help you in your analysis. So what's the objective? You want to do comparative analysis of similar companies and across the same company over a period of time. That's called horizontal and vertical analysis, We want to do income measurement. We want to look at wealth changes, the earning power, economic income, and permanent income. So economic income is economic profit, and permanent income is sustainable income, or sustainable profit. What can happen over a period of time? That's a big term that you see now. Sustainability. Concepts of economic income. It measures the changes in shareholder wealth. You want to know what's happening. You want to look at cash flows plus the present value of expected future cash flows for economic income. It's useful when you're trying to do it with the objective analysis to determine the exact return on shareholder value for the period. It's less useful for forecasting. It's not forward looking. Advantages. It reflects current information, which you know is historical, consistent with the measurement criteria, and you have comparability. There's not a conservative bias, and it's more useful for equity analysis. There's low objectivity. It's susceptible to manipulation. There's a lack of conservatism, and there's a excessive income volatility. Implications is a focus on the balance sheet. You're restating income. You're analyzing use of inputs, and you're analyzing the financial liabilities. The reasons for the difference between accounting and economic income. There's alternative income concepts. Historical cost is really what's happening with accounting versus economic. Accounting is what we typically use. Transaction basis. Accounting is transaction basis. Accounting has conservatism. Anticipate all losses and take no gains. Stated another way from the last time. And it's also subject. Accounting income is subject to earnings management. People playing with the numbers. That's it for chapter 2. I'll try and put up chapter 3 here sometime in the next couple days. And I hope things are going well for you. Have a great day. Thank you.